So we're looking at a pretty staggering statistic today. The sources are showing that right now, roughly 95% of trucking companies are getting outright denied for traditional bank financing.
Yeah, 95%. It's a massive number.
It's crazy. And, we're seeing major institutions like RBC, TD, Scotia, they're actively pulling out of the trucking sector altogether. They just want nothing to do with it.
Right, which creates this brutal disconnect for anyone actually moving freight right now.
Yeah.
Because on one hand, you've got this massive credit wall at the traditional banks, but on the other hand, the global factoring market is this $4.7 trillion industry.
Trillion with a T.
Exactly. And
Yeah.
in that alternative space, trucking companies are getting advance rates up to like 100% of their invoice value.
Hmm.
So, if you're just sitting there waiting on your bank to approve a loan, you are actively losing.
Well, and that's the mission for this deep dive. We've got this stack of 2025 and 2026 business intelligence briefings, trucking industry outlooks, and alternative lending data. We really want to unpack why the banks can't compete anymore and how you can actually navigate this huge factoring landscape without falling into the traps.
Because, let's be real. Even if you don't drive an 18-wheeler, this dynamic of liquidity versus credit, it dictates the survival of almost every small business out there right now.
100%. It's the ultimate stress test. So let's start with segment one here. Why are banks so fundamentally broken when it comes to funding these fleets?
Well, it comes down to who they're underwriting.
Yeah.
A traditional bank, they underwrite you, the business owner.
Right.
They're looking at your personal credit, your time in business, your financials. And honestly, if you've got a 580 FICO score, the bank is just going to laugh you out of the room.
Even if your business is actually doing great.
Exactly. But factoring companies operate on a totally different model. They don't really care about your FICO score. They underwrite your shipper.
So they're looking at who owes you the money.
Yes.
Yeah.
If you're hauling loads for, Amazon, Walmart, or these massive creditworthy brokers, the factoring company looks at that and says, well, Amazon's good for the money. Your personal 580 FICO it doesn't matter for the approval.
That makes so much more sense because the banks also have that ridiculous time in business requirement.
That's the 2-year rule.
Yeah.
Banks generally demand 2 full years of operating history. If you've been running for 18 months, you just don't exist to them.
But factoring companies don't do that.
No, not at all. Factoring companies routinely work with new operators who only have like 3 to 6 months in business. Because again, they're pricing based on your invoice volume and the quality of the shipper, not some arbitrary risk model that classifies the whole trucking industry as high risk.
Okay, let's put some real-world context to this because the sources gave us a great example. There's this scenario of a 3-truck owner-operator pulling in about $450,000 in annual revenue.
Right, a solid small fleet.
Very solid. But he goes to the traditional route, gets denied by 4 different banks, 4 of them. But then he goes to an alternative lender and gets approved for a $60,000 factoring facility in what, 48 hours?
48 hours, yeah. And it just shows how broken the traditional model is. But, and this is a big, but factoring isn't just free money. There are major structural choices you have to make. And if you get them wrong, it's brutal.
Which brings us to the $30,000 mistake.
Exactly. The whole recourse versus non-recourse debate. Most truckers, honestly, they don't understand the difference, and it ends up costing them real hard cash.
So break that down for us. What is recourse factoring?
Okay, so recourse factoring is the cheaper option. You're looking at rates around 1.5 to 2.5% per 30 days. But the catch is you carry the credit risk.
Meaning if the shipper doesn't pay?
You have to buy back the invoice. If your shipper ghosts you or doesn't pay within 90 days, the factoring company comes back to you and says, hey, we advanced you this cash. The shipper didn't pay. You owe us.
Wow. So you're basically on the hook for it. What's that alternative?
Non-recourse factoring. It's more expensive, usually 2.5 to 5% per 30 days, but the factor actually takes the credit risk.
Okay, so it's basically an insurance policy.
Exactly. You're protected if that shipper goes bankrupt. The factor eats the loss, not you.
So how do you know which one to pick? I mean, obviously everybody wants the cheaper rate.
Right, but you have to look at your customer base. If your shippers are Fortune 500s, like Amazon, Home Depot, Walmart recourse, is totally fine.
Yeah.
They're not going bankrupt tomorrow. They're not going to default on a freight bill.
So you just take the lower fee and run with it.
Exactly. But if you're hauling for, say, smaller brokers or brand new shippers you don't really know, non-recourse is absolutely worth the extra cost.
The sources outline this terrifying real-world scenario to highlight this. So imagine a trucker has $180,000 in outstanding invoices tied up with just one mid-sized broker.
And that broker unexpectedly goes bankrupt.
Right. So under a recourse agreement, the trucker has to just eat that entire $180,000 loss, which, let's be honest, wipes out almost any small fleet. They go bankrupt too.
It's a total death blow.
Yeah.
But if they had non-recourse factoring, the factoring company absorbs that hit. And sure, the trucker paid a slightly higher fee over the last 3 years. Maybe it cost them 30 grand in extra fees. But that 30 grand difference is absolutely dwarfed by surviving a $180,000 wipeout.
Yeah, 30 grand over 3 years is just the cost of doing business compared to losing your entire company overnight.
Exactly. It's catastrophic risk management.
Okay, so that's recourse versus non-recourse. But there's another huge distinction the sources emphasize: spot factoring versus whole ledger factoring.
This one trips up a lot of growing fleets. So, spot factoring is exactly what it sounds like. You pick and choose exactly which specific invoices you want to factor.
So it's super flexible, like a day pass to the gym.
Yeah, perfect analogy.
Mm-hmm.
It's great if you just have an occasional cash flow gap, but because the factor can't guarantee your volume, the rates are higher.
And whole ledger is the annual gym membership.
Right. You commit all your invoices to them. Every single load you haul goes to the factoring company. Because you give them that guaranteed volume, they give you their lowest rates. Usually it drops by a full 1 to 1.5%.
Which is huge for margins. But wait, what's the hidden trap here? The intelligence briefings mention something about direct pay customers.
Oh, this is the kicker. If you sign a whole ledger contract, and then 3 months later, you find this amazing direct pay customer who literally hands you a check at the dock.
You still owe the factoring company their cut.
Yes. You still owe them their percentage on those invoices, even though they didn't advance you any cash. Because they own the rights to your whole ledger, you really have to read the contract.
That is wild. So what's the smart play here for someone just starting to navigate this?
The playbook is pretty clear. Start with spot factoring while you're testing out a new factoring company. See if they fund quickly, check their customer service. Then, once you trust them and you've proven you have consistent volume, you negotiate a better rate and switch to whole ledger.
That makes total sense. Okay, so let's get into the practical side. Segment 4, the pre-qualification coaching. The sources actually give a specific 4-step walkthrough for how to get this factoring set up right.
Yeah, and step 1 is all about proving your volume. You need to prove your cash flow or prove your invoice volume.
So how does a trucker actually do that?
You pull your last 3 months of business bank statements, you add up all your deposits, divide by 3. If you're averaging over $20,000 a month, you qualify.
Okay, but what if you're brand new? Like you literally just got your operating authority last month.
Then you show them your broker contracts.
Yeah.
You show them your estimated monthly invoice volume. Because remember, factoring companies fund based on your future invoice flow, not some historical 2-year revenue chart.
Right, because they care about the shipper. Okay, so step 2 is knowing your facility size. And this is a big mindset shift, right? Because factoring isn't a fixed loan.
Not at all. It's a facility that is sized exactly to your monthly invoice volume. If you invoice $50,000 a month, your facility is going to be roughly $50,000.
And if you scale up and invoice $500,000 a month,
Then your facility scales to $500,000. It grows with you. And the sources specifically mention using BusinessLoan.Directory for this because their marketplace has over 75 lenders.
right, so they can handle facilities anywhere from 10 grand all the way up to $5 million. You just have to match your ask to your actual invoice volume.
Exactly. Don't ask for $1 million facility if you're billing 30 grand a month. It just wastes everyone's time.
Makes sense. All right, step 3, build your document packet. What do they actually need to hand over?
So there's the universal stuff, 3 to 6 months of bank statements, your photo ID, business tax returns if you've been around for more than a year, and a P&L.
Pretty standard business stuff, but there's trucking-specific documentation too, right?
Yeah, they'll need your DOT number, your MC number, and your current certificate of insurance. And this is key. The factoring company has to be listed as an additional insured.
Got it. And what about the actual invoices?
You need a sample customer invoice, a list of your top 5 shippers or brokers with their contact info, and the most important piece,
Yeah.
your accounts receivable aging report.
Ah, the AR aging report. The briefings called that out specifically.
Because truckers always forget it. You
Yeah.
can pull it right out of QuickBooks or whatever transportation management system you use. It is the single most important document for getting approved.
Okay, so you've got your packet together. What's step 4?
Step 4 is, do you actually go pre-qualify at BusinessLoan.Directory?
Just go to the site, tell them you run trucks and you need freight factoring.
Right. You give them your monthly invoice volume. It takes like 2 minutes. There is no hard credit pull, which is huge.
Oh, that is huge because hard pulls tank your credit score if you're shopping around.
Exactly. And because they have that 75-plus lender marketplace, they include factoring companies that specialize exclusively in trucking. So when they call you back and you have your document packet ready, you're usually funded in 24 to 48 hours.
It's just a completely different world than walking into a bank and waiting 6 weeks just to get a no.
It really is. Factoring isn't a sign of financial distress anymore. That's an old myth.
Yeah, the data says what, 59% of B2B businesses use it?
Yep. It's just a standard working capital tool now for businesses that actually understand cash flow.
But the biggest mistake you can make, and the sources hammered this home, is just signing with the very first factoring company that answers the phone.
Oh, absolutely. Do not do that.
Yeah.
You need to use a platform like BusinessLoan.Directory so you can get matched with 3 or 4 factoring companies at the same time.
Right, so you can actually compare their advance rates, look at their fees, and check their reserve structure.
You have to negotiate.
You have
You
to
have to negotiate. Make them compete for your ledger.
Exactly. So if you're navigating this, definitely check out BusinessLoan.Directory. Remember that 4-step prep we just walked through. And hit subscribe to this channel because we are doing a whole series on this trucking funding playbook.
It's going to be a deep series for sure.
But, before we wrap, there was one final provocative thought in the intelligence briefings that I want to leave you with. We've talked a lot about the traditional banks versus these fast alternative factoring models, but the technology is shifting rapidly.
The agentic AI shift. It's moving incredibly fast.
Right. We're moving away from human underwriters entirely. These AI systems are processing applications like 300% faster. But here is the catch. They are starting to look at non-traditional data.
Right. So it's not just your AR aging report anymore. As these AI models evolve, they are pulling in contextual signals. We're talking about inventory velocity, sure, but also your social media sentiment.
Right, like your company's Twitter or Facebook footprint.
Exactly. They look at the digital footprint of the founders and even unverified online reviews to predict your future payment behavior.
Which is terrifying. Because what happens when you have a fundamentally healthy business, great cash flow, good shippers, and you get denied capital because some black box algorithm didn't like your internet presence?
Or because of a coordinated wave of fake one-star reviews.
Yeah. What does the future of, algorithmic redlining look like? It's wild to think about. You could have the perfect business engine, flawless operations, and still get shut down by an invisible AI mechanic.
It's definitely the next major hurdle for the small business economy.
Something to mull over as you look at your own working capital. Until next time, keep your eyes on the road and your cash flow clear.